it seems to me like this market is really in the process of deflating. It's clearly the largest bubble in our lifetimes, not just 2008, not .com. I mean, this is the largest asset bubble we've ever seen. And with the Fed tightening and oil prices going up, and the economy looking to be, sliding into recession, I have no interest in trying to be clever and figure out when we're going to get some kind of snapback rally. I would rather just be in cash.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of our interview with macro analyst Stephanie Pomboy. If you haven't yet watched part 1 of this discussion with Stephanie, in which she explains why, despite today's very valid panic over spiking inflation, deflation is likely the bigger threat to worry about over the coming year, head over to our channel at youtube.com/Wealthion and watch it there first. It sets the context for the investment themes we discuss in this video. And we also tell you how to watch bonus footage of Stephanie explaining her origin story of how she became one of the most respected macro analysts in the business today. So stick around to the end of the video for that. Okay, let's get started watching part 2 of our interview with Stephanie Pomboy. I'm going to go back to a question I asked you right at the start here. Do you think that makes it, puts more pressure on the Fed to continue demand destruction, right? Because it's showing that it's not getting the system under control yet. Inflation's still going up, not down.
Well, I mean, I think it does feed into this idea that they have to do more sooner.
Yeah.
And then we'll see how much destruction is wrought as we get through the summer and into the fall. But it does suggest that, yeah, they've got to keep on keeping on, and hope that they start to get some traction in the next couple of months, and hope that over that time, the stock market is still above zero.
Right. Wow. All right. But okay. And the way I should have asked the question, but you answered it, which is, does the fact that inflation is still moving up at a record high for the past couple of decades, does that reduce the odds of a Powell pivot in the near future? And I think your answer would be yes, it probably does. And the reason why that's important is you've just made a really compelling case for, you think continued demand destruction is going to define the rest of this year, maybe going into next. You think that's probably, as you said, is going to bring down financial asset prices. It's going to slow the economy. It's going to lead to profit reductions. It may lead to layoffs. Bang, 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 bang. And so I now want to get to okay, so what does that mean? What should today's viewers, Wealthion viewers here, who are people who are trying to navigate this and preserve their wealth, at a minimum, maybe even position to prosper, but first and foremost, just not become collateral damage to this. What should they be considering? So let's switch now to sort of your market outlook. You just made a flippant comment of like, hey, provided the market has some value that's still above zero after this, but it's putting words in your mouth that you can then readjust. It sounds like you see, materially lower asset prices ahead, and that, again, the whole purpose of this video is to try to give people insight so they can take prudent action today before tomorrow. Is it fair to say that you would be encouraging people to be playing defense, at prioritizing defense at this point?
100%. I'd rather miss a stripping 10% rally here and be, on the sidelines when it comes back down. It seems to me like this market is really in the process of deflating. It's clearly the largest bubble in our lifetimes, not just 2008, not .com. I mean, this is the largest asset bubble we've ever seen. And with the Fed tightening and oil prices going up, and the economy looking to be, sliding into recession, I have no interest in trying to be clever and figure out when we're going to get some kind of snapback rally. I would rather just be in cash. And, I actually think, obviously, you and I have talked at length about gold. I think that's still somewhere you absolutely want to be. But I really don't despise cash right now. I think even though with inflation doing what it's doing, you're paying money to sit in cash. it may end up saving you a lot in the end, to avoid being exposed to, whether it's equities or what's happening in corporate bonds. And I would even say municipals. I know that that's not a topic that most people want to get bearish on, but I think if we do go into a recession, these state and local surpluses and the improvement in their pension funding situation will flip just as quickly as we went from 5% CPI in 2008 to minus 2%, 6 months later. I mean, this is how you see that it's not on a dimmer, it's a light switch on and off with those guys. And I would not want to be anywhere near munis in an environment where the economy is going into a real deep recession.
Okay. You mentioned pensions. I want to ask you about pensions in just a little bit. But so your list, I'm going to ask you about U.S. Treasuries here. And the reason why I'm asking about them is the list that you're sort of building here sounds a lot like both the four horsemen that Michael Pinto has mentioned when he's been on this program, and also the assets that Brent Johnson of dollar milkshake theory, says that he would, quote, go to war with. When those guys have been mentioning those allocations, they've really said this is when you get to the point where there's the big clearing event in the markets, and when that happens, you want to be in sort of safe and liquid assets like these. So on their lists, they have long dated U.S. Treasuries. Do you agree, or do you have a different opinion?
Well, for ages, I've been bullish gold and treasuries. Those have been sort of my core positions, let's say. And my concern now is that I never expected that the Fed would actually move forward with quantitative tightening, because I thought that by the time they completed the taper, the 10-year yield would already have backed up so much that they would realize there is no chance that they could ever shrink their balance sheet.
Hmm.
They seem to be moving forward on a delayed start, whatever, but we've already seen 10-year yields go north of 3%. I don't think that's accidental. So I don't know what the upside is on treasuries. I'm in my heart, I love the long-term treasury trade, just because, and you and I think have talked about this before. If you look at that long-term history of treasury bond yields going back to 1980, and it basically just goes like this.
Yep.
And you get a financial crisis at lower and lower levels of rates. What it's telling you is that our ability to tolerate a treasury yield much farther north of 3% than we are right now is extremely limited. I don't think it's an accident that the stock market buckles every time we get to or over 3.
Yep.
And I think that's an example of just how incredibly vulnerable the US financial system and the economy is to any increase in rates. So I like treasuries. I have them in my account, but if you were to ask me, would I be buying the 10-year today? I don't know that I would be rushing to buy that. I'd probably buy a 3-year treasury.
That's what I was going to say. What do you think about shorter dated ones?
Yes, on the idea that there's no chance the Fed is going to be able to deliver on the amount of tightening that's priced in there. So that right now would probably be my personal preference if I were putting new money to work. But that's because I already have a fairly big position in treasuries. The other thing I should have mentioned and didn't would be energy, which, again, I think strategic resources, I view gold and oil as strategic global resources.
Mm-hmm.
And, potential players in the new monetary regime whenever we get to that. And that's a much bigger topic for another day. But related to both gold and oil, I would probably also be interested in resource producers. So markets, economies and markets and currencies of resource producers rather than resource consumers. That's kind of another no-brainer trade in the new Mad Max world in which we're living.
Okay. All right. And I love that Mad Max kind of continues a car analogy if you watch the movies,
Right.
the Road Warrior, all that stuff.
And gangrene.
Exactly. There's a lot of gangrene in those movies, or at least a lot of chopping off of limbs.
Yeah.
All right. So real quick, I'm going to talk about energy in a sec, but back to the treasuries. What's interesting is I think, and I'm putting words in their mouth here, but I think guys like Pento and Brent talk about the long dated US treasuries in those environments because it's sort of the flight to safety, right? It's where global capital is going in. So you expect yields are going to go down as capital flows in there. Just curious if you have any thoughts on that beyond what you've already mentioned. Well, let's start with that, and then I'll do my follow-up question.
Yeah, I guess my only observation, and one day does not a trend make, is that today, for example, you've got the 10-year yield up, even as the dollar is very strong. So if there's a flight to safety into the dollar, it's clearly not giving a bid to the long end of the treasury market. I mean, or maybe it is, and the treasury market would be off a lot more if it weren't for that.
Yeah.
That's probably the case. But notwithstanding, rates have moved up in a day when you have risk off, and you would expect naturally for yields to be moving lower. Of course, we did see that hot inflation number, so that's another fly in the ointment there. But like I said, I'm a long-term bull on treasuries. I have them in my personal account. I just thought the question was, if you are doing, putting new money to work right now.
And that's what it was. So it's good.
Yeah.
You're answering the right question.
But I'm a bull on treasuries. I mean, I still think the gold and treasury trade, and I just think of that long-term history of bond yields. And I think if we're not at the threshold of pain, we're pretty darn close. And so maybe we go to 3.5. Maybe I'm kind of missing an opportunity here, but I got plenty of treasuries in my account right now.
Okay. Well, and I want to pull on the treasury Fed just a little bit more, because you made the comment that short-dated U.S. treasuries are now paying some sort of a yield, where for the past decade they really haven't, right? And so that's a safe way to get some yield. And then also it opens a bigger question, which is for the past decade, again, people flooded into riskier and riskier equities because they had the mantra of TINA. There is no alternative. I can't get a yield anywhere else. All the safe investments, the bonds that I would have bought as a pensioner back in the old days, I can't buy them now because they have no yield on them. So I got to go into these riskier assets to get some sort of return. Well, now all of a sudden you're passing that threshold where you actually can get a little bit of a decent return, still way below the rate of inflation, but a better return than they've been yielding for the past decade. And I think a notably better return now than the average sort of dividend yield on stocks, right? So are we going to start seeing like a vacuuming of capital from equities coming into the bond market now as a result of this?
Well, one would think so. I guess it all depends on whether people perceive this yet as a trend, or if they still think this is a temporary phenomenon. And I think part of that will be a function of when and how dramatically those earnings numbers come down, because clearly there's still a lot of optimism around the stock market in the latter half of the year. I mean, I don't know why, but clearly, the Wall Street hasn't yet acceded to the idea that earnings growth and therefore dividend payouts and buybacks are all going to wither as we move through the year. So it's, you have to embed those expectations, the negative expectations, before you really are going to see a shift in asset allocation, I would guess.
Okay. Yeah, I guess it depends how long the beatings continue for, but kind of like we talked about earlier, with the lenders and whatnot, investors, they tend to move like a herd, right? So they're gonna say, oh, hopefully this is just transitory, right? Hopefully we'll bottom here and we'll go back to the old days. But if we cross that threshold where they really begin giving up hope, that's when sentiment breaks, and that's when big moves like that can happen. I see you nodding as I'm saying this.
Absolutely. Say amen.
Okay. Well, so related to that point on confidence, when you were talking to Peter Atwater in your interview with him, he made, I think, a really great point where he said, people are really tired of the correction so far in the markets. It's been painful. They're frustrated. It's not fun anymore. And he said they kind of almost sound like kids in the backseat of a car on a long trip, just asking, are we there yet? Right. And his main takeaway was, uh, I study sentiment, and he said, I've never seen a bear market end on fatigue, but
Hmm.
I've never seen it end on whining. Like a bear market ends when people have just completely given up all hope. They do not ever want to buy a stock again. They've just, they've lost all of their confidence in the sector. And what I heard from him is he said, we're not even close to that yet.
Yeah, well, and as I remarked to him, I think in that interview, you need only turn on CNBC for 30 seconds to see that point underscored, because they're not talking about, oh my gosh, how much lower are we going? How bad is it going to get? They're composing their shopping list of what stocks they want to buy, and everyone they have on, what are your names? What are you looking to buy? What kind of, so it definitely feels that way. I don't know about you, but just anecdotally, I have friends who are not at all in this industry who dipped into things like Bitcoin and opened Robinhood accounts, and um, they don't advertise what they've been doing as much as they used to. It used to be the first thing they would say is, "Oh, my Bitcoin, blah blah blah."
Right.
But they haven't. I'll ask them, "So, are you still trading?" "Oh yeah, not as actively as it was, but I'm still, I'm looking at the things here and there." So they haven't completely given up yet, and I think I don't know what it's going to take to get them to finally exit, but
Yeah, well, it maybe goes back to the point of, there's just a point at which the beatings continue where they all of a sudden the mind shifts to, okay, this isn't going to end anytime soon, right?
yeah.
It's funny you made that point about the CNBC folks with their buy lists. Literally like 30 seconds before hopping on with you here, I saw come across from Twitter a retweet of someone retweeting Jim Cramer saying that the market is putting in a bottom here, and his special group of investors are buying their first stocks that they bought in a while. So yeah, the comment was, "Oh dear God," meaning like, he's great inverse sentiment, which probably means the market's going a lot lower from here. All right. Well, look, I want to kind of end on this question about, or maybe two questions, because I did say I'd ask about pensions, because I know that's something you've been watching. But before we get to pensions, there was a great headline the other day from Rabobank, from Michael Every, who I've interviewed on this program a couple of times, a really smart guy. And I really liked the title, which is, there are just two solutions to this inflation shock. One's extremely painful, and the other one is worse. Right. And I kind of feel like we are potentially sort of walking or perched on that knife's edge right here, where we may have to sort of decide, and we, the Fed, the people who are kind of in charge of the system, are we going to die by fire? Or are we going to die by ice at this point in time? Because you and I haven't talked that much in this interview, but about the debt burden and how much the debt has grown and how that's increasingly limits our options. Because as you've said a couple of times actually throughout this interview, once interest rates get above a certain level, the system just starts threatening to fall apart, because there's so much debt in the system, it can't deal with those higher rates, right? So I guess two questions. One, are we potentially at that end of the road where we either have to let the malinvestment clear naturally, which is a very painful deflationary event, or the Federal Reserve and the other central banks just say, well, we got to turn the printers up to infinity, and we're not going to let that happen, but we're just sadly going to have to kill our currencies in the process. And then the following question is should we be picking one of those paths? Like if Stephanie Pomboy were made empress tomorrow, would you just say it's time for us to take the pain? Yes, it's going to be an awful couple of years, but we'll emerge from the rubble. The sun will still shine, and we can have a much better system at that point in time. What do you think?
Well, I do have a weakness for the Austrian approach of, let's just let the system clear itself. And, I hate to be like a whiner from the peanut gallery, but had we done that in 1999, 2000 with the .com, or even 2008, we wouldn't be in the situation where the stakes were as high as they are today. But at every turn, the Fed has decided to take the path of no pain and just numb the problem by inflating a new bubble. And the fiscal policymakers obviously aren't blameless in this either. But so when it comes down to having policymakers, whether it's monetary or fiscal, choose the hard path, I just don't see it happening. I'd like to think if I were Empress, I'd say, we're going to do nothing. This is going to be awful. But ultimately, hopefully, it'll be awful for a short period of time and we'll come out the other end really in a great position. But I just honestly, I don't think there's any chance of that happening, which is why I alluded to the new monetary regime, because I just think the obvious conclusion is going to be that they're going to have to reverse all of the restraint now that they're attempting to impose. And they're going to have to open the monetary floodgates, and it will destroy the value of all the world's major reserve currencies, the dollar, pound, euro, yen, etc., to the point that finally we have to come up with some new monetary regime, because our creditors just say, that's it, you've defaulted, you've silently defaulted on our loans to you long enough. We're not going to take it anymore.
Gosh, what's so interesting about this, Stephanie, is we are beginning to enter the period of the timeline, I believe, where a lot of the things that we have talked about over the years are transitioning from becoming sort of academic discussions to becoming, practical observations of what's happening in the real world.
Right? I describe it as moving from lunatic fringe, sandwich board toting lunatic on the corner screaming about the apocalypse, to suddenly being acceptable, polite conversation is basically what's happened, right?
Yeah. Well, no, I mean, I think, and I mean, look, we're not quite there yet, but yes, it's amazing how much kind of just the mainstream analysts and media folks are talking about this have shifted just since January. Yeah. In terms of their at least willingness to consider that everything isn't always awesome all the time right now, or there may be things to be concerned about. But the point I was sort of making is, and this is really why I'm digging so hard with you into, do we think that we're heading into recession here, is because, again, I think it's becoming less of a talk about what may happen, and we're actually beginning to see it start to happen. And so I want to make sure that people are recognizing this so that they can take whatever prudent steps in their life that they think are going to best position themselves for what's coming. And personally, as I try to tell folks here, I don't think inaction or denial is a good strategy at this point. I see you sort of nodding as I'm saying this.
Yeah. Well, I mean, it's one thing, I've sort of built my business around trying to identify the unseen risks that aren't being priced into the market that I think people should be focused on. And what I've discovered is that I find it intellectually very stimulating. And I think it's always good to know what could go wrong, so that you're, to be forearmed is to be, to be forewarned is to be forearmed. But what you learn is how little appetite there is to hear anything negative. People don't want to hear that. Even if it's something just for information, like good to know that this could happen. It might not, but at least I can be prepared. But there really isn't a lot of appetite for that. And so you're in this business, you're sort of incentivized to come up with the rosy scenarios. And then everyone is kind of trying to one up themselves on who can have the rosiest scenario. And so that's, I think, part of the issue. And maybe it also feeds into this question of, or the reason why the sentiment can shift so quickly, so dramatically, when you can go from, yay, we're having hyperinflation, and then the next minute we're going off the cliff like Thelma and Louise, and people, suddenly have to completely shift their thinking just because they've been so trained for so long to only see one direction.
Yeah, you said two things there I think are important. One is there's that great cartoon where the two guys are sitting at a desk and one guy says an inconvenient truths, and there's nobody at his desk, and the other guy's desk says comforting lies, and there's a huge line there, right? I think just humans being humans, they like to hear good news. But you're reminding me about a video that I put out right at the beginning of this year that, now that I'm reflecting on it, was maybe a little more prescient than I even realized at the time, called "Don't Be a Deer in the Headlights." It's a very short video. I'll put up a link to it here. But the reason why I'm mentioning it is because things can shift so quickly here, and we see tougher times ahead as being more likely. Another very human reaction is to just become immobilized when you get caught by surprise by this stuff. And if you don't have a plan in place, if you haven't prepared for it, you can really get stuck in that fear, right? Fear and denial. And then, when things unwind, they tend to unwind a lot faster than they built up. And by the time you finally get kicking into action, well, you may have missed the opportunity
Right.
to move yourself to safety, correct?
Yeah, absolutely. It might be time to buy by the time you figured out how, what to sell and get out of.
Yeah. So all I'm trying to underscore here, and feel free to put any bow on top of this as we wrap up here, but it's just that this really is the time for people to be getting serious about, okay, if some of the things that Stephanie talked about actually happened over the next 12 months, what can I be doing today to put myself in a better position than I might be in right now, should that happen?
Yeah, absolutely. Well, and I think, just looking at the sentiment number that we got today and the CPI, both signal that we may very well be in recession right now while we're talking. You've never seen consumer sentiment at those levels and not been in recession. And, the same is true with gasoline prices or oil prices. Whenever they spike up at this magnitude, you've generally been on the eve of a recession.
Of a recession, yeah.
And then when you look at things like the run up in credit card borrowing alongside a slowdown in discretionary spending, that's generally been a leading indicator of recession. There are a lot of warning flags that we are in or soon headed into a recession. And the Atlanta Fed, their latest forecast for the second quarter is 0.9, which within the next couple weeks before the quarter ends could very well make its way to zero. So we're really within razor thin margins of getting into the technical definition.
Right. And if that were to happen, then that would be 2 quarters back to back of negative GDP, which by many people's description is technically a recession. And even if it comes in, it stays positive at positive 0.9. We were negative 1.5 in Q1. So we have net contracted in the first half of 2022. We didn't even get into jobs really much, the outlook for jobs. I've mentioned the word layoffs a number of times, and that's been really big on my mind. Like I said, I put some recent videos out about that. But everything we're talking about here just gets even worse, right? If people start losing their jobs, if we have millions of layoffs again. All right, look, we've gone way over time here, Stephanie. Thanks so much. I do want to give you a very unfair, I'll give you just 30, 60 seconds to say whatever you want to about pensions, and I'll earmark for this to give you plenty of time to talk about this the next time we have you on the program.
Okay, no worries. Lastly, I'm going to take some seconds to talk about employment. What you alluded to is a destruction in the demand for labor. I think we will simultaneously see an increase in the supply based on the evaporation of household net worth that led a lot of people who took early retirement come back to the workforce. Anyway.
I'm right with you. Just to build on that, I've said multiple times over the past couple of months, I think the great resignation is quickly morphing into the great unretirement movement.
Right, exactly. No, it's totally right. I agree with you. On pensions, I would just flag that as, this will be way down the road, and it will happen after, if and when the market completely deflates and we see, a reversion to the mean in valuations. And that is that in the first quarter, total US pensions saw their assets decline by 500 billion, their funding position declined by 500 billion. So they're now, in the red to, I think, the tune of $6 trillion. But that 500 billion deterioration in the first quarter, just recall in the first quarter, the stock market was down 5%. It's declined 11% in the span since. So that implies we could see another $1 trillion increase in the funding shortfall for pensions. I'm just pointing this out because the fact that we started with a $6 trillion shortfall should be just horrifying enough. But then that we can get up to these numbers so quickly. And this is what happened during dot-com and the global financial crisis, is that the short funding shortfall doubled. So if we started at 6, we could go to 10 trillion, which is why I come back to this idea that the Fed and fiscal policymakers are going to have to do a massive bailout, and it's going to be focused primarily on pensions, because they can't bail out Wall Street and not bail out the working man. So that's going to be a huge story, not this year, but probably in 2023 or after.
All right, so just yet another massive ticking time bomb here in this overall macro situation. I've talked a bit on this program, especially with Lance Roberts, about this. We don't have time to get into it in depth here, Stephanie, but just if that indeed happens, and there are massive bailouts of both Wall Street and pensions, you're going to have a material chunk of the country that's going to say, wait a minute, my taxes are going up to pay those Wall Street guys who already have all the wealth anyways, and to pay my neighbor who has a pension, but I don't. Wait a minute, I work just as hard as that guy. You know, as you and I think maybe said, at least privately, you know, if you've got a pension right now, if you have a healthy pension, it's like having millions and millions of dollars in the bank at current interest rates, right? So there already is, I think, some class, you know, friction over that. But
it's the same as the student loan thing. It's the same
same as the student loan things, exactly. So not it's, I guess what I'm flagging is it's not just going to be an economic development. It could very well have a very inflammatory social element to it as well.
Right. And the one thing about that, which if people really understand the problem when it happens, blame will be pinned squarely on the Federal Reserve, because most of these losses, the worst losses, will be borne by the pensions that were forced to take the most aggressive risk to generate an 8% return assumption in the Fed's 0% risk-free interest rate world.
Absolutely.
So they were really forced to buy all the most toxic stuff. So it's going to be really ugly. And I think you're right to point out the social consequences of that as well. But that's a story, I think, for next year. Hopefully we don't have to deal with that this year. One thing at a time, please.
Well, that's just it. I don't think we're going to get the luxury of being able to deal with one thing at a time. I think we're going to have multiple breakages going on here. All right. Well, Stephanie, first off, thank you so much for giving us so much time here. Thank you for being willing to answer the bonus question that we're going to record in just a moment here. And for folks that want to go listen to that, go to wealthion.com/Pomboy. But Stephanie, for folks who have really enjoyed hearing you in this conversation, maybe hadn't known you as well beforehand, where can they go to follow you and learn more about you and your work?
Okay, well, you can go to macromavens.com and find out all about me and my work. And occasionally, although not so often, I tweet on Twitter, and that's at @spomboy. But primarily, I would encourage you to go to my website and stay tuned to Wealthion.
Yes, because we will hopefully be seeing you back here as well, doing your magic as a guest host. All right, Stephanie, well, look, it's been such a pleasure. Look forward to having you back on this channel super soon with your next interview.
Thank you so much. Great to be with you.
All right, well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of Wealthion's endorsed financial advisors, to react to what Stephanie just said, but also to tell us what's going on in the markets. And there is a lot going on in the markets. This week, Mike Preston's on vacation, but we are joined by John Lodra. John, thanks for joining us.
Hey, good to be back with you, Adam. Thanks for having me, and pretty exciting and interesting time in markets for sure.
Yeah, well, so anybody who's been asleep the past couple of days, the new CPI numbers came out last week. Stephanie and I were talking about them. Markets had a little bit of a bump after that, but then they've really been selling off hard. We then had the Federal Reserve come out yesterday and do a kind of surprise 75 basis point hike. They initially said they were going to do just 50 basis points or 0.5%. People thought they might go a little bit higher. They did yesterday. Markets were up on that news, but thought about it overnight and are back down hard again. So I haven't run the latest numbers, John, but I know that the S&P is down substantially over 20% year to date at this point. So by the folks who define that as what a bear market is, we are solidly in bear market territory, because man, if you look at the NASDAQ, if you look at the crypto space, those things are down way more than just general stocks at this point.
Yeah, that's right, Adam. We've had a pretty decent pullback here off a technical bounce over the last few weeks. The market rallied a bit after quite nicely after the Fed meeting yesterday, an announcement. Oftentimes does that in recent years, where we get a nice rally on a Fed day, no matter what they say. And here we are today, the day after, and we're getting a pretty good sell-off, repealing all of that and more. It's interesting. We are down over 20%, but I want to pin on something that Stephanie hit in your interview, which was great. Stephanie's always a wealth of perspective and information, but profit margins are still being forecast by consensus to be increasing into the next year. And what we're likely to see is that not happen. And in fact, we're going to likely see, like many times is the case in major market tops, analysts scurrying to try to play catch up on earnings revisions downside. We still have profit margins at near record levels, and some of the worst bear market sell-offs, like in 08, 09 and the tech bubble, occur when you get massive overvaluation with massively inflated corporate margins. And we have a recipe right now playing out in front of us where those margins are likely to be under attack. Stephanie talked about the consumer sentiment and the inflation hit with food and energy, destructing demand by consumers in many other areas of their life. Companies are as measured by the PPI and CPI, are seemingly going to have a harder time to pass along input price increases to their consumers. So we're likely to see some pretty massive contractions in earnings that can only be resolved either by a sudden pickup in growth, which is we're actually seeing a lot of slowdown signs, or a pretty abrupt repricing to the downside of stock prices. And that's even with the technical bear market correction this year today already behind us.
Yeah, I think I said to Stephanie when we were talking about next year's forward earnings projections, I think I asked the question, what the heck are those guys smoking? Because if you just watch the video with Stephanie, I mean, it's very, very hard to make a prediction for what you just said, John, that we're going to return to robust economic growth to merit those types of increases that the market's currently predicting. In fact, I think it was just yesterday, the day before, Stephanie was talking about how fast GDP can decelerate, and she talked about what happened back in 08, where we went from 5 something to negative very quickly. Well, we went from over 6% in Q4 this past year to down negative 1.5% in Q1, and now the Atlanta Fed GDP, their GDP forecast for Q2 has been getting walked further and further down, but it was still positive. Well, it just went to 0. So now we are in a net contraction for this year so far, 2022. And there's not that much left in the year. If that stays at 0 or goes lower in the next couple of weeks, well, then we'll be sort of an official recession, the way they describe it, which is 2 consecutive quarters of back-to-back negative GDP growth. So I have no idea what those analysts are smoking in terms of making those earning projections. So folks, as much as the stock market has been getting, whipped and beaten right now, it's going to have further to fall just alone on those analysts walking their earnings estimates back. And John, I do just want to note here, we're talking on a Thursday. This video is going to come out the next day, Friday. Stock market's down, S&P is down over 3% right now. So a pretty big down day. And I did just crunch the numbers year to date. S&P is down 24%. NASDAQ is down 33%. Bitcoin is down negative 56%. I mean, these are pretty hellacious declines so far for the first half of a year. I didn't pull up the latest bond numbers, but I'm pretty sure that they're still down around 10% or so on average. So bad year still for stocks and bondholders, and potential for even more pain to come, as we just mentioned. So you guys at New Harbor, you're managing capital here. What at this point in the storm, what are you guys focusing on most?
Yeah, well, we still think we're in a regime here of probably a secular bear market after many years of a secular bull market, aided and abetted by the sugar high and other analogies that we can use by central bank monetary and more recently fiscal policy and the stimulus in response to COVID. Like Stephanie pointed out, I think folks underestimated how much those policies had to do with inflating unnaturally asset prices. And now that those policies are being removed by force because of the inflationary problems, I think folks are massively underestimating, like Stephanie, I think, believe pretty strongly, massively underestimating the carnage that will likely ensue. But what we expect is, like many bear markets, you're going to have very vicious counter trend rallies. Anywhere from a few percent to high single digits is certainly par for the course. But those tend to get repealed very quickly, and new lows are achieved. So, for example, we actually did put several weeks ago a tactical incremental stock market exposure for our marquee portfolio, and we sold it on a technical bounce. And we're getting close, we think, to having another opportunity on a new low here to putting another short-term tactical long position. But we do believe, and we're going to do so if we do so with hedges, because we do think there are substantially lower lows ahead of us. But we just recently, for example, sold out of that market position, but we also took some stops in a natural resource tactical position that we had. We do like natural resources, but in the short term, we honored our stops. We had some technical stops in there that we honored, and so far that's been the right thing. We obviously don't know, but discipline in investment management isn't just about buying; it's about selling as well. And so categorically, we think we're in a regime where preservation and defense is still very much defensive positions is still very much the way to be. So hedges, light equity exposures, large cash or cash equivalents. We do have some modest position in treasuries, which treasury bonds and treasury notes. That's been a pretty shocking tick up in yields recently. If you look at the 2-year treasury note, the yields went from say 2.5 to 3.25, almost, it looks like overnight. I mean, not literally overnight, but what a steepening, what a sharp rise in those yields. And of course, that in no small part was driven by the inflation numbers that came out most recently. And we think we're gonna see some rocky waters ahead, and defense still is the name of the game, in our opinion.
Yeah, John, and interesting that your allocation there, you just mentioned a lot of cash, gold, some short-term U.S. treasuries. Agrees very much with what Stephanie said. She thinks makes a lot of sense for the current conditions. So I'm going to put some words in your mouth here, John. Feel free to correct me in any way. But it sounds like you're saying, look, yeah, turbulent waters, likely to get maybe even more turbulent going forward for the vast majority of investors. This really is a time for defense, for safety, to be playing, to position yourself for safety against those lower prices ahead, knowing there could be some, face ripper relief rallies on the way here. I would say probably most people shouldn't worry about trying to play those, because they're violent and short-lived, and you can't time them with exact accuracy. So most people who have real jobs and real lives are probably just better off planning for safety and missing the rallies, but protecting against lower prices ahead. Let me pause here. Would you correct anything I've said so far?
No, not at all, Adam. And this really gets we working with real people, real clients, individuals, families, couples. Absolutely, they should be thinking about their longer term picture. And I don't say that in the way that most of our industry says it, in the sense of set it and forget it and kind of buy and hold and don't worry market. I say it in the sense of don't get too caught up in trying to time short-term bounces, or if you feel like you're overexposed to the markets and you've seen some downside in your accounts this year to date, either in your stock or bond positions, it absolutely is not too late to take defensive action, because we do think there is substantial downside more to come, especially in the stock market. But so really need to take a step back and this is an environment where one can be very fraught with regret, either regret for selling too soon or selling too late. And it's important to work through those and talking to a professional if you don't feel skilled enough yourself to put things into context. Right now, here and now, even with the abrupt sell-off in the stock markets year to date, still based upon historically reliable metrics, we're likely to see, if you were to buy an S&P index fund today, you're likely to see negative returns over the next 10 years or so. I mean, that's still what the numbers support. So think about that when you think about your retirement period, and that, slightly negative or negative return over the next 10 years, if it were to come, probably won't come in a smooth line. It'll probably come in the form of a very substantial sell-off further, or 2 or 3, that, if folks are at all worried about what we've seen year to date, these would probably put that to shame. And that's the tricky part, because if you're going to try and buy and hold through that, you better be prepared to hang on when it looks like the sky is falling, because that's exactly what happens. People get shaken out typically at all the wrong places. But not too late to take a fresh and decisive look at your portfolio and take decisive action.
Yeah, I'm glad you mentioned that, John. I want to shine a bright light on you and Mike and the team at New Harbor there for a moment, because you guys took your lumps over the past couple of years when you were taking the more defensive, hey, we don't have a lot of faith in today's crazy high asset valuations. And you were positioning more for safety at a time where people who were speculating were getting rewarded. And it kind of goes back to that John Hussman quote. Asset bubbles force you to make a choice to look like an idiot now or an idiot later. And there are a lot of people that were saying, you guys are the idiots sitting at this party, and now of course the tables have turned, right? And there's an economic framework called prospect theory that has proven this, that psychologically humans feel the benefit of a gain only half as much as they feel the pain of a loss, or basically you feel losses 2 times more than you feel the joy of a gain here. And so there's a lot of people right now who are smarting from the losses they've taken this year. And I just, rattled off how much all the indices are down. And some of those people, you get this, first you get kind of caught like a deer in the headlight. You don't know what to do. Market keeps correcting, you're riding it down. But then you kind of come to this resignation of like, oh, I've screwed myself. This is my fate. I just have to accept it. And I think it's really good for those people to hear what you're saying, John, which is it's not too late. There's still, a lot of potential for even further prices ahead. Don't just sit there immobilized, try to forget what's happened up to now and just ask what's the best thing for the wealth I have right now going forward. So hopefully, John, there's a lot of people that are taking hopefully some hope, some inspiration, et cetera, from here. But you guys are talking to people all day long. I'm sure you're probably getting some calls from some pretty worried people right now. What do you tell them?
Yeah, so first I want to say, yeah, we have been defensive for quite some time because the data has compelled us to be. And there is no victory lapping on our part right now. This is we are in this is a marathon, not a sprint.
And I'm sorry to interrupt, John. I appreciate that point, but can you give sort of just the general status of where your general portfolio is right now? Because my understanding last time we checked in that it was still roughly flat or maybe even up a bit given all the market carnage.
Yeah, I mean, I got to be careful. There is a little bit some dispersion across client accounts and whatnot, but generally speaking, our clients are in around the flat line. They might be flat or up a tiny bit or down a tiny bit, but on a relative basis, I can say categorically our clients in our kind of marquee flagship model are soundly outperforming, mostly through loss avoidance on the
yeah. 0% loss sounds pretty good, I think, to most people compared to 24%, 30-something percent, 50%, all those numbers I rattled off earlier.
Yeah, exactly. And yeah, this is a discipline, whether you're a do-it-yourselfer or sit in our seats, where humility is an absolute necessity, because these markets are by construct, in a bubble environment, they are meant to absolutely destroy psychology, destroy morale, get people to do the wrong things at the wrong times, and when things get as over extended and extreme as they have been and still are, frankly, we're talking about things that can reconcile over many years, if not a decade or more. Just to kind of put a point on it, for example, when the housing bubble burst and the markets reached their lows in March of 2009, and they probably had further to go downside if the Fed didn't come in with, rescue bailout plans and things like that. But even with that, any benefit of being in the stock market was wiped out for, back to like 1996, essentially 14 years worth of stock market, performance was wiped out relative to treasury bills, right? So that just puts it in context. There's a lot of years of overvaluation, we think, still priced into these markets, and the opportunity cost of sitting in them, frankly, we think far outweighs the potential of being safe and deploying that cash and safer assets at much better valuations that then can deliver returns that aren't just kind of inflated bubbles on a piece of paper, but the kinds of true economically growth tethered and corporate growth tethered appreciation rates that have long been the hallmark of the stock market over many years, accepting those periods of extreme over or undervaluation.
All right, well, really well said. Well, look, I want to shift quickly here before we wrap up to I did a video I mentioned earlier in the discussion with Stephanie, but I'll put up a link to it again here. A quick explainer video the other day of just sort of how the situation is deteriorating with the consumer household, just all the different headwinds that are really beginning to buffet them now. Stephanie mentioned that there's similar things going on, with corporate balance sheets here too. But I want to focus on the consumer for a moment, because those are the majority of people who are watching this video and are just trying to navigate this crazy environment and not become, victim to where the markets go next. And one of the things that the big shoes that I don't think has yet to drop, even though we're beginning to see some initial signs of this, is how weak I expect the job market to get. If we enter into true recession, stock prices keep coming down, if consumer spending keeps shrinking the way that it's going to with the Fed out there, both with the high prices that the organic inflation is causing, but also the Fed out there actively trying to destroy demand. It's very hard, to be honest, not to see layoffs being in the future here. And I want to make sure that everything that we're doing in these videos is helping people take as much prudent action now before things potentially get really bad, so that they're in the best shape possible if and when that happens. I have been on this channel sort of mentioning pretty frequently, we've got a free guide that folks should go check out, the Layoff Survival Guide. Folks, that's at wealthion.com/layoffs. I'll put a link to it in the description of this video below. But here's a reason why I just want to hammer home why we want to be taking prudent steps today in advance. I just got an email letter here. I'll keep it anonymous. But here's what the fellow said. He said, "Hi, Adam. I know you don't have time to read all the emails you must get from people like me, but I read Wealthion's advice for a layoff, and I've got to tell you, it's 100% good stuff. In November 2012, I was let go from a new job after only 7 months, and the first thing I did was get my part-time job back at Home Depot. Then within 30 days, I landed a full-time contract job at a company. The contract got renewed every quarter, so I was employed again pretty much right away. I stayed with that gig for all of 2013. I paid down debt, but made a rookie mistake of not setting aside enough for taxes, so folks remember to do that. In any case, that job saved my bacon. In December, I was hired at my current company and due to start in early January 2014. I didn't fully know how my family was impacted by my job situation until Christmas of 2013, when my wife advised me to wait until Christmas morning to share the good news about my job with our daughters. Before we opened presents, I told them about my new job. They were so relieved and happy. It was the best Christmas I can remember as a family, from my point of view. Anyways, I've been here 8.5 years on, and I'm earning more than I ever have in my life. I was 54 years old when I was laid off. Statistically, only 10% in that age group ever earned their previous highest salary. So I've been pretty darn lucky. I'm glad you have advice for a layoff on your website. Really good encouragement for folks." So I share that because stories tend to motivate us. And I want to make sure, again, that everybody who works for a paycheck is asking themselves the question, what could I be doing today to make myself less vulnerable to a layoff or be in a better position should I actually, unfortunately, get a pink slip from my current employer if the macro situation worsens farther from here. So John, anything that you guys at New Harbor, are counseling people to do right now, today, in advance of what might happen going forward?
Yeah, Adam, and first, I'd like to say kudos to you. That's great feedback. I'm sure that makes you feel really good. And that's frankly what we like our team like about our jobs. Obviously we're deep into markets and we study markets, but it's the people that we connect with and the clients that we serve and, their stories and the life decisions that they, share with us or ask for our counsel on. And of course, finances fit into all those kinds of life decisions, but those are the kinds of things that really make our jobs fulfilling. And, while we talk about portfolio reviews and stuff like that, we, every client that we talk with, we want to learn about them and what their set of circumstances is. But, this is the kind of stuff that I think is always timely. It just happens to be valuable when things become uncertain. We always expose the virtues of, simplicity, not in a kind of a popper kind of way, but in finding simplicity, the simple things in life that can create meaning. But oftentimes that also translates to, hey, I don't spend as much. I don't feel like I have to go out and keep up with the Joneses. But yeah, debt consolidation, debt retirement. We've told folks to pay off mortgages probably more than many of our peers would, just simply because it's not always a financial decision. Sometimes it's an emotional decision and a resilience decision to be debt free. And it's the value of that decision may not become apparent until uncertainty starts to rear its head and a job is lost or whatnot. So those are the kinds of things that we oftentimes will counsel folks about, and it goes far beyond just their portfolios. So yeah, keeping things flexible, invest in yourself. I mean that, figuratively and literally, work on market turmoil and economic turmoil, if that's what we're in store for more of. One of the best defenses for that is getting in touch with your emotions, taking a step back and realizing that, life will go on. It will. You certainly want to be a stick in the mud or have your head in the sand, but the world will not end, or at least, as we know, some parts of it may, but the basic essential life will continue. And take a step back and talk it through. We are as much counselors at New Harbor as we are investment strategists and financial planners, and that's all part of the equation that makes money just a tool for our clients, not a master.
That's a great way to say it. And John, you and I have worked together for years in the company I was at before founding Wealthion, and I know working with you, it's about the full spectrum of wealth. We talk a lot about financial resilience here now at Wealthion, but physical resilience, emotional resilience, et cetera, are just as important components of the puzzle, especially when we're heading into harder times like now. And I love that you guys sort of work holistically with clients around all that. All right, folks. Well, look, the key part to all of this is just to sort of, try to light that fire under folks that haven't quite taken the time to focus on their current situations and say, hey, now is the time to actually start taking action, folks. The actions you take before crisis hits, way more valuable to you than your options you have after the crisis has already arrived. All right, well, look, in wrapping up here, I've been doing this with a couple of guests recently. Folks have really been enjoying it. I did ask Stephanie sort of her origin story. How did she go from, starting her career to ending up being the highly respected macro analyst she is now? The answers are great. If you want to hear them, go to wealthion.com/Pomboy and watch that video after this one ends. Obviously, again, if you haven't taken the hint, highly recommend that you schedule some time to talk to your financial advisor. Maybe send them this video with Stephanie and say, hey, how am I positioned right now for what this lady's talking about? If you've got a good advisor, have that conversation with them, stick with them. A good advisor is worth their weight in gold. If you're having trouble finding a good one, or you just like an informed second opinion, you can talk to John and his group there at New Harbor. You can talk to some of the other financial advisors that Wealthion endorses. It's totally free. There's no strings attached. You don't have to work with these guys. They literally just do it out of the goodness of their hearts as a public service. If you want to figure out how to do that, stick around at the end of this video. It's coming up in just a couple seconds. We tell you how to do that. And if you enjoyed having Stephanie on this program, would like to see her on again, as well as other guests of her caliber, please support the Wealthion YouTube channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And then again, don't forget to go watch the Stephanie Pomboy origin video over at wealthion.com/Pomboy. All right, John, look, thanks so much for joining us this week, especially when you're on the road there. And whatever the markets do from here, we will be tracking it on this program together next week. Everybody else, thanks so much for watching.
Thank you, Adam. Appreciate it. And we'll see you all next week.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.